Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of our very own fee-only certified financial planners. Please note this podcast is intended for educational purposes and should not be considered financial or investment advice, as we do not know all the variables to one's personal situation when answering a question. Before we jump into today's question, a shout out to our extraordinary YFP financial planning team that makes this segment possible. Your Financial Pharmacist offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to pay off your student loans, make the right investment decisions, or simply build a solid financial plan, we'll help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Frank in Bonita Springs, Florida.
Hi, Tim and Tim. This is Frank Macias from Bonita Springs, Florida. I have another question for you guys. Hopefully you can help me out here. We signed a contract with a local builder here in September of 2020. And we're currently in the process of building a duplex. Anyways, the builder has come back to us and said that due to the increase in building materials, i.e. lumber and other things, they're going to need an additional $30,000 to complete the duplex build. So the issue that we're having is, well, how do we fund this? We can't get funding from our mortgage lender because that loan has already closed. And so some potential ideas I had were taking out a personal loan, maybe perhaps borrowing against my 401k, or maybe doing a HELOC or a cash out refinance on our current house. Anyways, if you could help me out about some pros and cons of each of those, or maybe some other things I didn't think of, that'd be great. Thanks so much.
Thank you, Frank, for submitting your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Tim Baker, what are your thoughts?
Yeah, this is a tough one, Tim, because, it's definitely one of those things where it's not necessarily a bait and switch. You thought you were paying this, but then you're paying that. Obviously, the environment that we're in right now with materials and things going up, it happens. So I think before I get into how can we particularly fund this, how do we avoid this? So things like, Frank, if you're looking at this in the future, cost plus contracts. So these are contracts that include the cost of materials and labor, and the plus could represent either a fixed fee or a percentage that could include a GMP, a guaranteed maximum price. So the project basically has a cap.
Mm-hmm.
GMP contracts are typically attractive to people because they shift a significant amount of the risk to the party performing the work, and it kind of gives you a clean price, so to speak. So definitely something to kind of consider, in the future to kind of avoid this type of stuff. So that would be definitely, and maybe what you sign has this, and you can point to that, before you do anything. But if you have to kind of dig into your own pocket, if you were a client, this would be definitely an opportunity kind of to dust off the balance sheet and look at everything that's available to you to kind of access these funds. So I think first off, I would look at the liquid assets first, Tim. So is this an emergency? I don't know. I don't know if I would, but I might tap into that depending on what that is. Most real estate investors should have a real estate fund or a CapEx account that basically covers things like this that come up. And, you don't necessarily anticipate them maybe, in this stage of the investment, but those would be two areas that I might look at in terms of liquid assets first. From there, I probably would look at debt next. So, Frank mentioned a cash out refi or a HELOC. A cash out refi, for those that are not familiar with this, is basically where you replace your current mortgage. This could be on a primary home. It could be on another investment property, but you replace the mortgage with a new mortgage that's higher than your outstanding balance. So in this case, you owe $100,000 left on the mortgage, but then you refi it with new terms and you refi it, say $130 in Frank's case. So then you could take that $30,000 and basically do what you want. So in this case, it would be to pay the contractor. Now, typically, Tim, most lenders are going to still want you to have 20% equity in the house. So you can't, if the house was basically, in this case, if it was worth 130, they're not going to let you take out all 130. Like they're going to want you to have some equity in the home. But the other big thing that kind of, that would be necessarily, it would be a negative, would be like the transaction costs.
Mm-hmm.
So every time that you refi a mortgage, you're going to have closing fees, so origination fees and all that kind of stuff. Now, it might be a good situation to do this because you know that you're going to have the property for a while. You might look at that rate and be like, well, it was 4.5% and I can get it closer to 3%. So it might make sense to do that. But the other option that was mentioned that is out there is a HELOC. And think of a HELOC as like a bigger credit card. So this is an evolving source of funds, much like a credit card that you can access as you choose. And it's basically backed by your house. So there's typically lower rates associated versus like what you'd pay on a credit card. And there's typically a lot less fees associated with this compared to like a cash out refi. So you don't have closing costs. You might have like an origination, like when you go to access the money, there might be like a service fee or things like that. Now the rates here in some environments could be scarier. They're typically very variable rates. And you can see some fixed rates with terms, but typically it's going to, the rates are going to change with an index. So that might be a thing to kind of access funds. And some people use this, Tim, as like an emergency fund. So they're like, I really don't want to put money aside and have it make no money. So some people do use a HELOC for that purpose.
Or a backup, right? To an emergency
Yeah, like a
fund.
backup to a backup. Exactly. And then the other use of debt is you could do a home equity loan. So this is different than a HELOC, which is a home equity line of credit. A home equity loan is actually, you think of this as like a second mortgage. And this would be like a lump sum that a lot of people use this for like one-time expenses. So sometimes people do this that are in dire straits with credit card debt. It could be something like this that Frank's in. It's usually fixed, but then again, you have basically two notes against the house versus just one, and you're going to see those same things, closing costs. And the last thing that Frank mentioned would be a personal loan.
Mm-hmm.
And I looked on NerdWallet. If you search NerdWallet personal loans, rates can be anywhere from 4.5% to 36%.
Jeez.
So they can be, again, depending on your credit, depending on your income.
Yeah.
They can be worse than credit cards. And again, these are typically unsecured, so they're not backed by collateral like a property. So they're going to be more risky. So you're going to pay a higher rate. Now, if you compare that to like a home equity line, you could probably get lower rates on average. A HELOC, I saw HELOCs that are anywhere from 3.25%, to 7%, above 7%. So those are just things that, and it's going to be different depending on who you use. So debt would be definitely, something to look at. I would probably look at a cash out refi depending on what the original note looked like, if I can stomach the transaction fees, or probably a HELOC to bridge the gap. And then the last place I would look at is then the assets. So these are things like, investments. And this is tough, Tim, because again, it's more about time in the market versus time in the market. Now, if you were thinking, hey, I'm smart, I want to time the market, you could potentially make the argument that the stock market is at all-time high, so maybe now is the time to get money out. I don't necessarily subscribe to that. I think, keep it in the market is the best scenario. But if you take a 401k loan, you're going to pay it back typically through, your paycheck with interest. So it's, instead of having that exponential growth of the investments growing, you're going to be putting that money back with every paycheck, and you're paying yourself an interest rate, which is more, a linear growth versus exponential growth. That's an option. But the other thing that you could potentially look at, maybe before that, would be your Roth IRA. If you had a Roth IRA, Frank, you can take your basis or the amount of money that you contributed at any time without penalties or fees. So as an example, let's pretend you put $5,000 over the last, $5,000 every year over the last 6 years. 5,000 times 6 years is $30,000. You could pluck that out of your Roth IRA. So not any of the earnings or anything like that, without penalty, and do your thing. But I would probably look at liquid assets first, then look at the debt, and then probably look at the assets next, because I think pulling from assets will probably have the greatest impact in terms of your nest egg and wealth over the period of time. whereas the other ones, it'll still affect your wealth, but not at a greater degree, in my opinion.
Yeah, really good review, Tim. I think the takeaway I had as I was listening to you is there's a lot of different options, right? And Frank mentioned, several of those in his questions, but you talked about, things to look at on the asset side, obviously a HELOC, cash out refi, a home equity loan, a personal loan. And I think this is where it can be so helpful to just talk those options out loud to make sure you're evaluating everything that's out there, you understand what's out there, and then looking at the rest of the financial plan, understanding which one of those levers may make the most sense to pull. So Frank, do keep us updated. Curious to see where you go with this decision into the future. And again, we thank you for taking time to submit your question. We're going to be sending you a super comfy YFP t-shirt as a small thank you. And to those that are listening to the YFP community, if you'd like to have your question featured on an upcoming episode of Ask a YFP CFP, please go to yourfinancialpharmacist.com/ask YFP, or you can send us an email at info@yourfinancialpharmacist.com. Have a great rest of your week.